The current time is Sunday, December 14th, 2025. The markets are currently closed. Warner Brothers Discovery, Inc., NASDAQ WBD, closed the last trading session on Friday, December 12th at exactly $29.98 US dollars, registering a gain of $0.49 or 1.66% for the day. This is not the script you expected to hear 2 years ago. If you rewind a clock to late 2024, the expectation for Warner Brothers Discovery was a grim march through a debt-laden swamp, with analysts predicting a slow bleed of linear television assets and a desperate struggle to keep Max profitable. The common belief was that CEO David Zaslav was simply cutting costs to survive. The reality, however, has shattered those expectations with a violence that Wall Street rarely sees. We are not watching a company struggling to survive. We are watching the single most aggressive bidding war of the decade. And if you are holding WBD stock, you are currently sitting at the poker table with the biggest chips in the industry. The narrative has shifted from survival to super acquisition, and the price action at nearly $30 reflects a market that is pricing in a massive premium for the crown jewels of Hollywood. Let's look at the immediate tape, because Friday's close of $29.98 is psychologically massive. We are tickling the $30 level, a resistance point that seemed impossible when this stock was languishing in the single digits back in 2024. The volume on Friday was heavy, over 45 million shares changing hands, which tells us that institutional conviction is not just present, it is dominating the flow. You were seeing a battle between arbitrageurs, those betting on the deal closing, and the skeptics who think regulatory hammers are about to fall. The stock is up nearly 30% since the start of December alone. Why? Because the market is finally calculating the sum of the parts, and it turns out splitting the atom releases a lot of energy. The catalyst here is the dual threat scenario that emerged earlier this month. On December 5th, 2025, the bombshell dropped. Warner Brothers entered a definitive agreement to acquire Warner Bros. Studios and HBO assets for an enterprise value of roughly $82.7 billion. That sent the stock vertical. But the drama didn't end there. Just days later, Paramount, backed by the deep pockets of the Ellison family and Redbird Capital, threw a wrench in the gears with a $30 per share all-cash counteroffer for the entire company, claiming their bid offers superior certainty compared to Netflix's complex stock and separation deal. This is why we are seeing that price pin right at $29.98. The market is effectively telling you that the floor is now the Paramount bid, while the ceiling could be even higher if a bidding war escalates or if Netflix sweetens the pot to secure the DC universe and the Harry Potter library. When you look at the chart, you aren't just seeing a line going up, you are seeing the repricing of legacy media. For years, the expectation was that legacy studios were dead weight. The reality we are living through this week is that content libraries, proven century-old intellectual property, are the only scarcity left in the streaming age. Netflix has the distribution, but they realized they needed the depth of the Warner archive to retain subscribers who were churning out of pure fatigue. By attempting to buy Warner Brothers, Netflix is admitting that the build it and they will come model is too expensive compared to buy what they already love. Now, let's talk about the structure of this potential deal, because it is critical for anyone holding shares in an individual brokerage account, whether you use Fidelity, Schwab, or are trading on the Robinhood app. The Netflix proposal involves a separation, a spin-off of the Discovery Global linear networks. This means if that deal goes through, you end up with shares in two companies, the new Discovery entity, which holds the cable channels like HGTV, Food Network, and TLC, and then you get the payout or stock conversion for the premium assets going to Netflix. The Paramount offer, however, is cleaner: $30 cash. Take the money and run. This tension between a complex, potentially higher upside future, Netflix shares plus spin-off, versus the immediate gratification of cash, Paramount, is what is driving the volatility. Investors using platforms like Interactive Brokers or SoFi Invest need to be very careful with their margin requirements right now. If you are leveraged, a regulatory announcement from the FTC blocking the Netflix deal could send this stock tumbling back down to the mid-20s in a heartbeat. The antitrust implications are enormous. A Netflix-Warner combination creates a streaming behemoth that controls a terrifying percentage of Hollywood's output. The government might prefer the Paramount deal, or they might block both. This is the risk premium you are seeing in the price. It's not trading at $35 for a reason. The market is leaving room for the deal to fall apart. Let's pause and look at the company's actual performance leading up to this mania. It's easy to get lost in the merger headlines and forget the business itself. In the third quarter of 2025, WBD actually showed some resilience that surprised the bears. They've been aggressively paying down debt, a legacy of the initial merger that created the company. That $40 billion debt load that terrified everyone in 2023 has been chipped away, partly through aggressive cost-cutting and partly through better cash flow management. The studio segment had a strong summer, and Max has finally started to see meaningful churn reduction as they bundled it with other services. However, the discovery side of the business, the linear networks, is still a melting ice cube. Advertising revenues on linear TV have continued to decline, which is exactly why the split makes sense. By separating the high-growth streaming and studio assets from the cash cow but declining linear networks, the board is trying to unlock value. Investors using Schwab Intelligent Portfolios or other robo-advisors might have seen WBD rebalanced out of growth funds and into value funds over the last year, but now it's strictly a special situations play. If you are self-investing, you have to ask yourself, do you want to own the linear networks post-split? The expectation was that David Zaslav would be the villain who stripped the company for parts. The reality is that he might be the architect of the biggest exit in media history. He has effectively positioned the company to be the belle of the ball. The NBA rights saga, which caused so much pain back in 2024 when they lost the package to Amazon and NBC, actually forced this hand. Without the NBA on TNT effectively anchoring the cable bundle, the standalone future of WBD became much harder, pushing them towards this sale. It's a classic case of a short-term loss, losing the NBA, accelerating a long-term realization. We need to sell. I want you to take a second and comment below. If you were the CEO, would you take the $30 cash from Paramount and walk away, or would you gamble on the Netflix stock deal and the spin-off? Comment cash or stock below. I want to see where the sentiment is. Now, let's look at the competitors. Disney is watching this with absolute horror. A Netflix that owns DC Comics and HBO is a direct threat to the Disney Plus and Marvel dominance in a way that Netflix alone never was. If this deal closes, Disney might be forced to make a move of its own, perhaps looking at other smaller players or doubling down on their own consolidation. Amazon, meanwhile, is sitting pretty with the NBA rights they stole from TNT, but they too must be eyeing the landscape. If Netflix secures the Warner library, the value of Prime Video arguably diminishes in relative terms. This consolidation wave is what everyone predicted, but the speed at which it is happening in late 2025 is breathtaking. For those of you managing your own portfolios, perhaps through Fidelity Wealth Management or even just a simple Fidelity IRA, the tax implications of the spin-off are something to watch. Spin-offs are generally tax-free, but cash buyouts are taxable events. If the Paramount deal wins, you're getting cashed out. That means capital gains tax. If the Netflix deal wins, you might be able to defer that tax liability by rolling into Netflix stock. This is a nuanced point that often gets missed in the headline shouting matches. Let's expand on the Discovery Global spin-off entity. What is it? It's essentially a collection of unscripted reality TV assets. It's cheap to produce, it has a loyal audience, and it generates cash. But it has no growth. It's a yield play. If you are a dividend investor, that new company might actually be interesting. It will likely pay a fat dividend to compensate for the lack of growth. But if you are a growth investor, like many who trade tech stocks on Robinhood, you will likely dump those shares the second they hit your account. This creates a potential selling pressure on the new entity immediately after the deal, which is a classic spin-off arbitrage opportunity. We also need to discuss the regulatory elephant in the room. The FTC has been incredibly aggressive under the current administration. Blocking the merger of two major studios is right up their alley. However, the argument WBD will make is that big tech, like Apple, Amazon, and Google, has broken the media landscape, and the only way for traditional media companies to survive is to combine. They will argue that Netflix